Good evening, everybody. Welcome to the webinar today. Thank you so much for joining us. My name is Kiana Danial. I'm the CEO of InvestDiva, and today we're going to talk about new strategies for the new year. What a start to a new year. It has been crazy, and of course, a lot of trading opportunities, not only in Forex, but also in the stock market. For those of you who've been scared but what's been going on and what's been reported on the news, my answer to you is don't be, because the market sentiment sometimes have nothing to do with the actual process of the economy, and I do believe that we are going to be in better shape. But in the meantime, while we have all the volatility in the Forex market, it is great time to actually get into the market and take advantage of the volatility and the fear of other traders. Basically what we want to do, we want to outsmart them. Before we start today, I would like to quickly ask you to type in a Y for yes if you can hear me properly. And if you can see my screen right now, on the screen I have New Year, New Trading Strategies with the Orbex logo. So if you could, thank you so much everybody for responding so fast. Let me welcome you personally. Wow, we're getting more and more people. Welcome Alexander, Francis, Michael, Raf, One, Zelenson, Melissa, Mohammed, Maria, and everybody else who are joining us as we're talking. Hopefully today I'm going to walk you through at least 7 of the major currency pairs. So without further ado, let me start by switching my screen into our Forex trading platform. So definitely do ask me any questions if you have during the webinar. I will try my best to respond to you. So if you have not heard it by now, let me just tell you that today's market moving event was ECB's chief president Mario Draghi's speech a few hours ago, and we had a ton of volatility before that. And today what he did is that he hinted at more stimulus to be added to the Eurozone, and on the news European stocks surged, and it was basically because the signal indicated that more efforts to bolster the Eurozone economy could be in the pipeline. But right now we're actually on the news. Euro versus the dollar actually went down, testing our support level of 1.08, which is a level that has been holding the euro from going down in the past 2 weeks. If you have been in our webinars before, you might know that I am a long-term euro-dollar bear, and it has panned out before. Our previous target was at 105. We got out of the market with profit, and the markets went back up again, because in the Forex market, one goes down, must go back up, and vice versa. That is the difference between the Forex market and the stock market. You always have opportunities with Forex, because if it goes down, you're going to make money if you're in the right trade, and if it goes up, you're going to make money if you are in the right trade. So let's take a look at euro dollar on a larger time span, moving back to the monthly chart and going back all the way to, oh, this is the minute chart. Monthly chart is right over here. So we're going back all the way to 1994 over here, right? And the reason why I'm doing that is what you need to keep in mind is that the Forex market moves in cycles, right? And there are 2 currencies involved, 2 economies involved in every currency pair that you trade. Therefore, when you are looking at the euro dollar, you should not only be worried about what's coming out of the Eurozone, but also be worried about what's coming out of the US. How is the US economy doing? And the best scenarios are always when you pair a weak currency with a strong currency. So for example, if you think that the euro-dollar pair is going down, what does that mean? That means that euro, look at this pair over here. I'm pointing to euro. If euro gets weaker as a currency and the US dollar gets stronger as a currency, what happens? That is our ideal bearish scenario, because since the US dollar has been quoted second in this pair, that means the stronger it gets, that will actually push the euro dollar pair down. So what we want is having a weak euro and a strong US economy. And that is why you can understand why I'm bearish on the euro dollar pair on a long-term point of view. The reason why is that the US economy has been doing all right. It's added to its jobs. It's been doing good with its GDP, and we had the first rate hike in over a decade in December 2015. So even though the stock market started a crazy plunging week the beginning of the year this year, I do not attribute that to the weakness of the US economy. The reason why was the Chinese economy and the fear of the market. People, I mean, you have to understand, the markets move not because everybody knows exactly what is going on. The markets move based on crowd psychology. And the crowd psychology a lot of times is not based on anything logical but fear or greed. And the reason why we've been seeing all this drops in the stock markets around the world has not been really based on any logic. For example, let's say Google stocks have been dropping like crazy, and that is not because Google as a company is doing bad. It's only because the traders on Wall Street who know nothing about technology have been in fear, have been on a panic attack. They probably came back from their holidays, from Christmas and New Year holiday. They saw the markets going down. They heard something about China, and they're like, oh my gosh, I have to get out of this market. They started selling. Everybody else started to follow them because people follow other people for no good reason sometimes, and that's what happened. And we got a new sentiment of bears attacking the markets, and everybody just on TV and on the news, on Facebook, on Twitter, everything that you say is just negative, 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 only because of emotions. So it's very interesting how the markets move based on emotions. And what we do with technical analysis is actually analyzing the market psychology and the emotions of other traders, the crowd, and trying to take advantage of it, right? So going back to Forex, the euro dollar pair did not move as much during in the past couple of weeks since January 1st. But the reason why I'm looking at a longer term point of view of this chart is because I want to show you the levels that the market has tested before. And what happens in the Forex market is that, okay, we have right over here, I apologize for so many indicators. I might want to get our Ichimoku cloud out of here so that you don't get as confused. All right, so now you have a better view of what's been going on. We've had a cycle, and this is now our second large cycle since the internet was really popular, became really popular, and Forex trading began from 1994, right? And the lowest euro dollar has gone is this level right over here, which is below parity at 0.85. Now, is the market really going to go all the way down over here? Probably not. But the bottom line is that we have this cycle, this very long-term cycle that started all the way back in 2001. We had the peak during the US market crash in 2007, 2008, and then we've had minor other cycles going on. So this time the market was basically testing these two levels. Let me show them to you so these are the levels that the markets tested, right? These are called zones. A little bit below it, a little bit above it, and what happened in 2000 15, which was significant, was that the prices actually broke below this very strong psychological level that has been holding the euro dollar from going down for over a decade. So that was significant because when it drops, as I said, that is the market sentiment, that is the crowd psychology. When it drops, that opened doors for further drops. And we did see further drops towards 108, 105 multiple times. It tested it 3 times since it reached it. The last time being the last month of December, and I remained in my bearish position. I got into this position back around over here, and I waited it out. It went up over Chinese panic, it went down, and finally it reached my position, and I made some pips over 3 months. As you know, I am a long-term trader, and the strategies that I'm going to point out to you are mostly based on long-term analysis. If you are a day trader, I can help you with that as well. You just have to ask me questions, and I would be more than happy to let you know what I think about it. So the bottom line is that we have now the 101.05 level as a strong support level, which, by the way, the market had tested before back in 2002 and all the way here back into 1997. So as you can see, it really doesn't matter how many years has passed since the markets tested a level. 15 years later, when we have something going on in the market, these levels still hold, and they can be attributed to our trading strategy. Next support level, if the markets do break below 1.05, is obviously parity. So here I'm going to give you a trick, right? The trick is that yes, we have these support levels. 105 was one of them. But when I came up with my strategy, I didn't choose 1.0500 exactly as a point of target. I did it a little bit above 1.05. Why? Because yes, these are psychological levels, but sometimes it just doesn't, the market sentiment is just not as strong to reach quite that level. So the trick is to, if you're in a bearish position, is to have your target a little bit above the level so that you don't miss out on a market plunge and you actually do get out with profit. It's a little bit less profit, but it's still profit, and you don't miss out on getting out of the trade. So this was the long-term view of euro dollar. Let's see what is going on today and what we can expect. So as you might notice right over here, the euro dollar has been, yes, you guessed it, has been consolidating between, well, I have it a little bit wide over here, but 1.11 is a very strong resistance level, but a little bit below 1.11 and 1.08 today tested 1.08. It was not able to break below it. We had a false break of 1.08 back in December, I believe this is, and it went back up, and we're still consolidating and ranging, and this has been the new way of euro dollar, if you want to say the new hobby, the new habit of euro dollar is ranging. It has been ranging for quite a while after it plummeted in March 2015. It's been basically ranging between these two levels, and what we're really looking for is a break. And because of what is going on in the Eurozone and all the problems that they're having with their countries such as Greece, and the fact that the UK is thinking of getting out of the Eurozone, although they don't share the same currency, but it still could affect the euro should they decide on that, and all the other things going on in the euro. The Eurozone economy doesn't, the Eurozone outlook doesn't look as good as, let's say, US and even the UK. So the strongest economies that we have at the moment in the world are actually the US and Japan. China is just uh, fooling everybody with false probably data that nobody can actually confirm, and we really don't know what's going on over there. But US as itself on its own is actually doing quite well no matter what people tell you, and whatever is happening is basically based on crowd psychology. So with that in mind, it's basically a matter of time when euro dollar, I believe, would go back down, and at least we could see the 1.05 level tested another time. And on the other hand, nothing is ever guaranteed in the Forex market. Let's say something massive happens in the US, somebody attacks the US, or a global panic happens that really affects the US economy in a negative way, or a miracle happens and the euro zone gets into a very, very good position against other countries. In that case, of course, we could see the euro dollar change direction. We have our resistance levels obviously set for that, for such events. So let me have them. I normally have them in a different color. It is kind of all right. All right, I'm not going to change the color right now, but what we have at the moment is 1.08 and 1.11 as pivot levels. What that means is we're waiting, the pair is ranging. A break, a confirmation of a break below it would bring us to the support target of 1.05. A confirmation of a break above it would bring us up to 1.14, which is a resistance level. And as I said, if you are for any reason bullish on the euro dollar and you are targeting 1.14, I would recommend that you slide your target a little bit lower and target 1. Let's say 1370 to have your odds more on your side. All right, so that is our first resistance level, and something that would really change the process is actually a break above one of these very important Fibonacci levels. I'm going to use our technical analysis over here. So as you can see, the 61% Fibonacci level actually falls directly on one of our resistance levels at 1.26. And then we have the 50% Fibonacci, which is at 1.22. And we also have the 38% Fibonacci, which it has not actually reached in the past even rally that we had back in August, and that is 1.18. So the Fibonacci resistance levels, what they offer us is, and how the markets normally behave based on the Fibonacci, is that it tests one of the resistances. If it is able to break above it, we could see even further bullish market sentiment until next one, and until next one, and until next one. But the 50% is the most is the strongest one, and the idea is that normally it tests 50%, or it goes up all the way to 50%, and then it goes back down. That is basically a market behavior. That normally, though, this 50% is more useful in shorter term trading. So if you are a shorter term trade, you would use Fibonacci resistance level in this trend, let's say, from the top over here to the bottom of a trend. Let me just quickly explain for our audience who are not familiar with Fibonacci. The way you use Fibonacci retracement levels is that you find a trend, Okay, even within this range, we still have trends going on, albeit they are not as massive. So for example, here we had an uptrend going on, and then we had another uptrend going on, we had consolidation, and then we have a downtrend going on, and now we have another consolidation. So within these small ranges, you can also use Fibonacci retracement levels for shorter term trades. So let's use Fibonacci retracement levels for our most recent downtrend, which brings us to exactly what we identified as support and resistance levels before, even prior to Fibonacci. So the reason why I'm bringing up Fibonacci is if you're not able to find support and resistance levels, it helps you. And the funny thing is that normally, because a lot of traders know about Fibonacci retracement levels, it happens to fall exactly on the support and resistance levels that some people cannot identify with naked eye. So as you can see, the 23% Fibonacci level is almost at this area, 1.08, and the 38% is the pivot level right over here, is the center of our consolidation at the moment, and the 50% is actually our most recent resistance level at 1.10, which is a little bit lower than what I told you before. The reason why is obviously now you can see how the crowd psychology really moves the market, because a lot of people use Fibonacci and 50% was at 1.10, and that is how this became the new resistance level for us. So the idea is basically the market is going to probably consolidate until it breaks below the 23% or above the 50%. You can use both these levels. If you're in a bearish position and you're targeting any other levels below this, you can use the 50%, let's say, or 61% based on your own account and the amount of margin that you have as your stop loss, which means if the markets do go against you and you don't have enough margin to remain in this position, you can get out of the market. One thing that I want you to keep in mind is that, especially with the recent rate hike, we have a rollover interest rate that you may either gain or have to pay while holding on to long-term trade, long-term positions. Normally they are very, very minor. There are 0.01 or 0.03 dollars per night. And if you're in a positive position, positive rollover, which means, for example, depending on your broker, again, that changes, but euro dollar, actually a sell rollover is positive. So no matter how long you stay in it, you actually will gain a 0.2 dollars per night. So that is why I am a fan of remaining in a bearish position on euro dollar, because if I say, let's say I stay in the market for 6 months waiting for it to reach my target, in the meantime I also earn $3 or $4, which is minor, but it's still better than nothing. On the other hand, the rollover fee for a euro dollar buy position is minus 0.36. That means if you're in a buy position and you stay in it for 6 months, you have to pay a fee of whatever it adds up to, adding $0.036 per night. So when you are trying to pan out your strategies, definitely take a look at your broker's selling rollover fee and buying rollover fee, and decide whether this is going to be a long-term strategy for you or a short-term strategy for you. We're having Anthony. I cannot see the webinar. The screen is blank. All right, let's see if this is a problem that is you only having, or I'm getting response that everybody else can actually see the screen. So Alexander, I do recommend, I'm sorry, Anthony, I do recommend that you probably go out of the webinar and come back again. That may help you see the screen, because right now all the technicalities seem to be all right. And if it doesn't work for you again, you probably want to open up your Orbex account, and I can, without seeing, what I'm showing right now is basically the euro dollar daily chart. So that is it about euro dollar. Are there any questions about euro dollar that you might want to ask before we move on to our next currency pair, which involves British pound, and then I would like to get to Canadian dollar. If there are no questions, I would move on to our pound dollar. Platform. All right. So here it is. Pound dollar has been, oh my God, going down like there is no tomorrow. And right over here, like only looking at the daily chart from back in April 2015, the first thing that we can identify is a saucer top pattern right over here that I'm smoothing out my mouse. And then we had a neckline right over here when it started, and guess what? The pair actually broke below the neckline. This was a support level, and therefore it opened doors for it to fall even lower. So now the question is, what's going to happen? Is it going to continue falling, or are we going to have a correction coming up? Well, right now, today, it actually had a very crazy day. If we go to an hourly chart, you can see that it went all the way down to 1.4085, and now it's actually recovering. It has been recovering in the past 3 hours. But what is going on a longer term point of view? This is the longest we can see with pound dollar. And what's significant about this chart is that, look at this. We have the lows in the past 20 years. This is one of our lows right around here in 2001. Next, we have the low in 2008 right over here. And then we have the low today, this month in 2016, in January. And the interesting thing is, unlike euro dollar, pound dollar has never been able to break below this zone, break below this level. The lowest it has ever gone is 1.35, and it was merely testing this level, and it did not go back there again. So this puts pound in a tricky position, because if it does fall and reaches 1.35 one more time, and actually I won't consider 1.35 really as a support level, because it was only a mere testing. The real level that we're looking at in the long term is actually 1.40. This zone is the actual support that has been tested over and over again. So we're looking at, is pound really going to be able to break below it or not? And that is why I have been in a bearish position, targeting 1.4050 actually. I was giving myself a little bit of a space for error. And after that is when I'm going to make a decision about pound. Pound has been consolidating or ranging basically between this level and 1.70 right over here in the past 8 years. And we are now waiting for a potential break. The interesting thing on a technical level on the monthly chart are these 1, 2, and 3 black crows, 3 massively bearish candlesticks forming. And here is actually where we can again use the Fibonacci retracement levels to see if the support level does hold, what we can expect, what levels we can expect in terms of a correction. A 3 black crow technical term is when you have a formation of 3 candlesticks that are in the same direction and they are very strong. Normally after that we see a market correction. So that means we've had a black crow back in November, a black crow in December, and a black crow in January. Chances are in February we're going to see a correction. So if we do see a correction, how high can we go basically? And so for that we can use again our Fibonacci retracement level, and we can use it either from the most recent downtrend, which started right over here, or we can go back to the top, to the highs of 2014. I would like to, because we're on the monthly chart, I would like to take a look at it from a longer point of view to see what levels it gives us in a longer term. So here it is. The 23% actually falls very closely to our resistance level at the moment of 1.46. It's like this zone between 1.46 and 1.48. Then we have the 38%, which actually falls into the support level right over here that the markets had tested this level before. Then we have the 50%, which doesn't really give us anything. And then we have the 61, which is the resistance of back in June 2015. So now let's see what happens if we do the Fibonacci retracement level on the shorter scale. Please allow me to remove this Fibonacci. It is a little bit tricky with my mouth. All right, there we go. So now we have the Fibonacci right over here in a smaller point of view to see for a shorter term frame what we can expect. So the first level is 23%. So if the market does correct, we can expect it first to reach this level right at 1.4450. Right, and next we have the 38%, which actually falls on our previous support level. So going back to daily, here are the levels that we can expect. So right now we've had a correction, and if you are in a bearish position in pound dollar, you might want to have your stop loss at 23% right over here. And the target, as I said before, is 1.4050. So how does this affect other pound pairs? So let's say pound yen has also been in a crazy, let me actually bring it up. So we're going to add a new chart of pound yen. So with pound dollar, we noticed that the market had never gone below 1.140. And there is a good chance that it might not be able to do that because it's basically, it's very rare for pound to get there. But when it comes to pound yen, this actually is not the case. Pound yen has been dropping even more than pound dollar. The reason why is because the Japanese yen became the safe haven in Asia after Chinese stock markets crashed and the yuan has been very unstable. Everybody, all the investors turned into the Japanese yen in the region and started investing in that. That is the reason why we have the Japanese yen to be the strongest currency at the moment. With really like leading indications. So and as I said, because the Japanese yen in this pair, let's say pound yen over here, the Japanese yen is quoted second. So with the pound yen pair, the stronger the Japanese yen gets, that actually pulls the pair down. At Investiva, I call it a currency pair dancing, right? The reason why is that it's really literally like a two currencies dancing, and one of them is a leader, one of them is the follower. With the pound dollar, for example, right now the leader is pound, and it's getting really weak because their governor Carney said that they're not really even close to have a rate hike, and they might even consider quantitative easing, and that is really taking its toll on the British pound, and the Mr. British pound, as I call it, is really under pressure. The US dollar right now is kind of clueless because it's like, okay, what is going on? The US economy is doing well, but the stock market is crashing, and China, I don't know what's going on. So she's kind of clueless. She's not really leading anyone. But when it comes to the pound versus the Japanese yen is actually leading. So we have two leaders. We have the pound being very weak, and we have the Japanese yen being very strong, and that combination could actually lead, even though pound could see its support level versus the US dollar over here and stop being a leader when it comes to pound yen. Depending, when it comes to pound yen, we're not really looking at economic news out of the UK anymore. We have to be on a watch out on economic news out of China, which directly influences Japanese yen. And if China is doing really, continues to do really bad, the pound yen has a higher chance of dropping comparing to pound dollar, and that is basically my point. So with the pound dollar, we're basically reaching a very strong support level. We don't know where the market is going to go after that. We have to wait for a confirmation. But with the pound yen pair, the technicalities from here, you see we've had a strong uptrend over here, and it's very valid to use Fibonacci retracement levels to see what levels we're looking at. And right now it's exactly testing the 38% Fibonacci level. We're right at 1.16550, and if it breaks below it, the next level would obviously be the 50%, and it is very possible, especially if China continues to shock us with other news. This week, the beginning of the week, they tried to make us a little bit relieved, but this really hasn't been the case. And the significance of this 50% Fibonacci level, and the reason why we might actually see it going all the way down, is because it has previously acted as a resistance, this zone right over here. It is not exactly this number, but it is basically in the zone, somewhere between the 50% and the 38%. And also back in 2000, this actually has acted as a very strong support level that actually changed the direction of the market and turned it into a bullish market. So from the technical point of view, we could see further drops, especially if it breaks below 38%. So if you're not in a pound yen position and you do have a fundamental point of view that the Japanese yen is going to get stronger and the UK economy is going to get weaker, the technicals are on your side, and you might want to consider getting into a bearish position with pound yen, targeting a little bit above the 50% Fibonacci level, which brings us to around 160. If you want to be safer, you can consider 161. All right, so this is our pound yen strategy. Any questions up to here? We have covered so far the euro dollar, the pound dollar, and pound yen. In the meantime, while you're writing your questions, let me share with you a wonderful news that we had yesterday. Yesterday I won the Women of Influence Award from New York Business Journal. You can see the article on our website, invesdio.com, and I'm very happy about that, as our goal is to empower more women into getting into trading. So if you have any women, thank you so much for your congratulations messages, everybody. If you do have any women in your life who are not into investing and they're probably scared or don't know how to invest, that is Investiva is definitely the place to be, and we get them, educate them, and empower them to see if investing is for them, and if it is, we educate them step by step into growing their wealth by investing like a rock star. It is very important to me because this market has been very male dominated, and there are not many women. We have been growing our community, but not at a pace that I've been hoping for. So we are really looking into making a movement and getting more and more women involved. So definitely share the word and get more women to take a look at our website at investdiva.com. So now we're having questions. Oh, these are not questions. These are all congratulations. Thank you so much, everybody, for the congratulations messages. And if you don't have any questions about what we've covered so far, I am going to move on to Canadian dollar, which, oh wow, it did drop today. The reason why is because of oil prices that they started to move back up again. And again, it did reach a bunch of resistance levels that we had been talking about in our previous webinars. It went all the way from 129 to 145 even, and now it's retracing. This retrace, we were seeing it coming. I wasn't expecting it to happen today, but it did happen with oil prices going up. But if you have been in a bullish position with dollar CAD, we do have very important economic data coming out of Canada tomorrow with their CPI, core retail sales, and that could also affect the Canadian dollar's fate. So let me tell you a little bit about how Canadian dollar and it reacts and what influences it. This rally that we saw here was solely because of oil prices. Canadian dollar is directly influenced by low oil prices. The lower the oil goes, the lower Canadian dollar goes. And then you might ask, okay, then why does dollar CAD go up? That is again because US dollar versus Canadian dollar, I'm pointing at the pair right here over now. Canada CAD is quoted second, so that means the stronger it gets, the direction of the pair is down, and the weaker it gets, the direction of the pair is up. So in this uptrend that we had, Canadian dollar was getting weaker and weaker, and US dollar was getting stronger and stronger. So that was a perfect strategy, perfect combination of a strong currency versus a weak currency. Today, we didn't have much out of the US, so today's rally of Canadian dollar, which eventually pushed the dollar CAD pair lower, was basically based on Canadian dollar. US dollar had nothing to do with it. The US dollar didn't get weaker. It was Canadian dollar which got stronger across the board, not only versus the US dollar, but also versus other currencies. And technically speaking, this actually does make sense because we've had a period of rally, and you know what? The currency pair that we call them dancing in one direction, they get tired at some point, and they want to basically, you know, take a break, go back down, and then they can shoot back up. So adding, if I add this Fibonacci here, this is going to be really too much for you guys. So let me first try to get rid of this level right over here. There you go. There it is. Delete this one. And then I'm going to delete this red one. Oh my God, this is, all right, there you go. So, and then I'm going to try and delete this one. If I don't, please forgive me. All right, I'm going to add Fibonacci for this uptrend to see how low we can expect the dollar CAD go. So right now it's rapidly approaching the 3% Fibonacci level. This level could either hold or it can break it and we could see further drops towards 38% or the previous support at 140. All right, so if you are in a bullish position, if you don't have enough margin, you might want to get out. If you have enough margin and you want to wait and see if it actually can test 23%, then wait and see and be my guest. And I would recommend that if you got into the market, I don't know where you got into the market, but if you want to remain there, definitely do bring down your bullish target a little bit lower, because we have seen a kind of a reversal of the sentiment in the market. If you're not in a position with dollar CAD, a good point to get in is if it reaches 23%, I would get into a bullish position at this point, and aim anywhere between this level and this one or above, because you want to get in when the market gets lower. But at that time also you want to be aware of what is going on. This can really highly depend on what comes out of Canada tomorrow. So let's talk a little bit fundamentals and see what we can expect from a fundamental point of view. So due to the Bank of Canada's decision to maintain rates, contrary to their expectations of most Forex traders that we were thinking about before, still the fun on the loonies, the fun with CAD, may not be over, because we've got these two top-tier economic reports coming up tomorrow. So the first one is CPI, which is scheduled for tomorrow, Friday, January 22nd at 1:30 p.m. GMT. And so let's see what has been going on with the CPI. The headline on the monthly headline has been minus 0.1% versus the 0.1% expected. So that was bad. That's bad for the Canadian economy. Therefore, the dollar CAD pair has been going up. The headline yearly, the annual headline, has also been lower at 1.4%. The expectation was 1.5%, and the previous year's number was 1%. So even though it was higher than previous year, it was lower than the expectation. Therefore, the economy, the Forex traders didn't react well about it. So the readings for November were pretty disappointing for Forex traders, and since the headline reading printed a 0.1% monthly decline, while the core reading printed a 0.3% monthly decline, the headline reading did look better on an annualized basis. So for the upcoming CPI report, what most market analysts are saying is that the headline reading will go down on a monthly basis because of the recent slump in oil. So the expectation is that it's not going to do well tomorrow. So guess what's going to happen? If it actually, so even though the expectation is going to come lower, if it comes higher, but it's still lower than previous time, we're going to see another boost in Canadian dollar. That is going to result in a drop in dollar CAD. But if it comes lower than expected, lower than the expected minus 0.3%, that is when we can see the market dollar CAD pair shoot back up, because Canadian dollar is going to get weaker, and therefore the dollar CAD pair is going to get stronger. Unfortunately, there are only a few leading indicators for Canada's CPI, but in their Industrial Producer Price Index, IPP, did print a 0.2% decline during the November period. So that basically shows that everything, like even from dairy products and meat and fish and everything else, were down as well. So Canadian economy is not doing that well. So we could, that is the reason why the analysts are expecting a CPI of lower than before the lower CPI release, basically. The next coming up economic event for tomorrow is the retail sales, which is at the same time. They're going to both come out at the same time tomorrow on Friday. And both headline and core readings last time failed to meet the market's expectations, but both readings also managed to beat previous readings. So we are always looking at two things: what happened before and what's the market expectation. So if it comes out below market expectation and below previous, that is going to be really bad for Canadian dollar. That is going to push it higher up. If it's like better than expected but is lower than previous, then it's going to be like a mixed kind of a signal for us, right? So the best scenario is if it's lower. For a bullish scenario on dollar CAD is if everything is lower than expected and than the previous reading. So that is when you can actually have a strong indication that it's going to go higher up. I normally don't recommend trading on Fridays. So tomorrow with the dollar CAD, if you are looking at dollar CAD, I would recommend that you look at the outcome and wait for the market to react to it. You have the technical analysis right now, and then make a decision. I am going to do a long-term analysis of dollar CAD in a moment, but before, let me give you my final thoughts about the fundamentals. Both the CPI and retail trade reports will be released at the same time, which complicates things. So if the reports conflict, we basically, like, the markets are really going to get confused. That is the reason why I'm recommending that you don't trade this, like trade the short term. Don't trade the news. Wait for it. Wait for the bulls and bears and the investors to just fight it out, so that we can have an actual direction with a dollar CAD. But personally, I think a downbeat CPI report has been priced in already, because the Bank of Canada did warn in yesterday's monetary policy report that total CPI inflation is expected to remain well below 2% through 2016. However, the Bank of Canada's accommodative monetary policy is meant to facilitate a Canadian economy towards a non-resource sector. And a retail trade is a major component of that, since retail sales are the primary gauge for consumer spending. So consumer spending is going to help keep the Canadian economy afloat if it does come in positive tomorrow. So I think the retail sales report is going to have more weight between these two economic events, between the CPI and the retail sales. Retail sales has got to have more effect. So if the retail sales turn out negative, that is going to be a stronger indication that the dollar CAD is going to move back up to its original trend. If it's better than expected, then we could actually see drops in the dollar CAD towards the 38% or even 50% Fibonacci level. On the positive news for dollar CAD bulls, I would like to move towards the monthly chart, which has been really great actually. We have been talking about this in the past 6 months, I would say. So in the monthly chart, look what has been happening since 2014. We had a downtrend, then we had a little bit of an uptrend. It was supported at 1.27. Then we have another cycle going up. What does this resemble? This is a double bottom. And what double bottom normally indicates is that after it tests the neckline, and if it breaks above the neckline, we can expect the market to move up approximately the same size that from the amount of pips from the bottom of the double top towards the neckline. So here we have from 0.95 to 125. That is around 2,500 pips. So there is a good potential, good possibility that we could see the market going higher up. The one thing that we do want to keep in mind is that we have a very strong resistance level over here, 144, 145. This is the previous support and now turned into resistance. This month we had it. We had the market tested. It's now going below it, so we're not really sure if it's going to continue on a technical point of view, if it's going to be able to break above this resistance level. Our next resistance level on this point is right over here, the previous resistance level that the market had been checking out in the past, which is 150. So if it does break and confirm above 145, chances are we're going to see even further up moves towards 150. These all, so the things that you want to keep in mind, just to sum it up with dollar CAD. For dollar CAD to reach 150, we need these scenarios. We need lower oil prices, even lower than what it is right now. Right now is like at 20, what do we have oil price right now? Today we had a rebound of it. So oil prices has gone back to 29. This is absolutely the reason why dollar CAD got up today. So if the oil prices continue to remain in the 28 area or even go lower, some analysts say it could go as low as $10 per barrel, which is crazy. This is what you want. This is the first thing you want. You want lower oil prices. You want lower than expected retail sales report, lower than expected CPI report from a fundamental points of view with dollar CAD. Technically, you want a break above 145. These are your 4 indications to get into a bullish position in dollar CAD once again, if you have not been able to take advantage of all the rallies that we've seen before. But one thing is for sure is that the market, dollar CAD we have 3 black crows right over here in the opposite direction as well, 1, 2, and 3. So February we might actually see a little bit of a correction before it shoots back up, even if oil prices drop further lower. So technically we are in a little bit of a wait and see situation right now. The best time to trade would be after the news tomorrow when the market settle down. But if you want to jump in, if the market first initially knee-jerks down and then it starts to move back on you, you might want to jump in at that time as well for a short-term trade, get like 100 pips and get out of it. All right, so that is it for dollar CAD. We have 5 minutes remaining. I'm more than happy to answer any questions that you may have about any of these trades. Otherwise, I would quickly like to take a look also at dollar yen before we go. And dollar yen, as I said before, the Japanese yen has become the safe haven of Asia, and it is now supported by 116. It has not been able to break below it. We had a better day today because of better than expected Chinese reports, but just to quickly give you the support and resistance levels of dollar yen, we have 116 support. We have, this is actually not correct, I don't know why I have it over here, but we have 118 as pivot, and we have 121.50 actually. Oh, we have it right over here. 121.50 is our main resistance. It has tested it over and over and over again. So this is a very major resistance level. If it breaks above it, the market is going to switch back to bullish, which I do believe it is going to happen towards the end of 2016 with targets at 125. If you are trading, thinking of getting into a long-term trade with dollar yen, the good news is that the rollover fee for dollar yen is also positive. So if you remain in it for a year, you're not going to really miss out on anything. You're just going to accumulate rollover fees over the months and over the nights that you're in this position. So that was that for dollar yen. Lastly, I would like to refer you to Orbex's Trader Library. If you haven't checked it out already, definitely do. They have daily market updates, and if you do have any recommendations for next month's webinars, definitely do send your questions to info@orbex.com. If you have a question about the markets tomorrow or anytime after that, You can also reach out to Orbix about your questions. I'm always also more than happy to answer. If you go to investdiva.com and you can subscribe for free on here as well and ask any questions that you may have. Also, we have a weekly update and weekly education videos that we send out that you can get for free if you subscribe. Again, thank you so much for attending, everybody. We had a great turnaround today, and next week I'm going to have a session of live trading. It's going to be more with short-term trading analysis, depending on how the markets span out. And if you are in it, I will be covering different currencies, probably based on what's going on, but I will try to cover other currency pairs next week. So definitely come over next week as well. Check out the Orbix Web TV for my twice a week videos that I talk about market updates. And have a great day. Obviously, invest responsibly as always.